Hello, economics students. Today we're going to talk about exchange rates. Imagine that you're walking down the street of Tokyo, Japan, and you're in an area with lots of shops, and you look at a store window and you see a beautiful cashmere sweater for sale. And you look at the price tag and it says this sweater is going to cost you 8,900 yen. Should you buy that sweater? Well, 8,900 yen, that sounds like a pretty hefty price tag for a sweater. However, it's not a hefty price tag for a cashmere sweater. You're not going to get many cashmere sweaters in the United States for under $100. However, 8,900 yen is actually only about $79. So if you're in the market for a cashmere sweater, even though that price tag looks extremely high, 8,900, it's only equivalent to 79 US dollars. I would buy that cashmere sweater if I were you, if in fact I was in the market for such a thing. So exchange rates are kind of odd. The numbers actually mean virtually nothing when you compare the numbers of, from one country to another. So let's get into this and see what exchange rates are all about and how the exchange rates are actually determined. So let's get started. Here's a definition that I want you to get into your notes. An exchange rate. Exchange rate is simply the value of one nation's currency compared to another nation's currency. You don't need to write this stuff down, but I thought it might be interesting to show you the value of the US dollar versus other countries in the world that we trade with quite a bit. Again, this is not something you need in your notes, but it might be kind of interesting. Note, though, that this exchange rate that I'm about to show you is the exchange rate for early December, December the 4th, 2021. The exchange rates on December the 4th, 2022 will almost certainly be different than what I show you today, just as the exchange rates today are different than they were a year ago in 2020. So here's some examples. Today, $1 equals 0.88 euros, or if you had €1, that would be equivalent to $1.13 in US money. The next one down is the British pound. $1 equals 0.76 British pounds. 1 pound equals $1.32. By the way, this is kind of interesting. You may be familiar with the term Brexit. Back about 5 or 6 years ago, the UK left the European Union. And before the UK left the European Union, $1 would have been only about 0.5 euros, or €1 would have been somewhere in the neighborhood of $1.75. So when the UK left the European Union, the value of their currency, the pound, went down significantly. International affairs like that will have an impact on the value of a nation's currency. Going on down, the value of $1 in Japanese yen would be 112.8. or 1 yen is equal to 0.0089 US dollars. You can see the relationship with China. $1 equals 6.38 Chinese yuan. 1 yuan equals $0.16 or 16 cents. $1 equals Canadian $1.28. 1 Canadian dollar is equal to 0.78 US dollars or 78 cents. Interesting thing about this, I went on my honeymoon about 26 or 7 years ago to Canada with my new wife, and my wife kept looking at prices and thinking, man, things are sure expensive in Canada, and she was failing to realize that the exchange rate, a Canadian dollar, was much different value than the US dollar. Things looked expensive as we were shopping based on the prices that she was seeing. However, in reality, the prices were actually a little bit lower than what we would have gotten in the United States when you take into account the exchange rate. Okay, moving on. Let's get a few more definitions in. First of all, depreciate. When the value of currency goes down compared to another country's currency, we would say that that currency has depreciated in value. Okay, so if the dollar, for example, used to be worth 1.05 euros and now the dollar is worth 1.13 euros, that means that the dollar would have depreciated against the euro. The value of it has gone down. The opposite of depreciate is appreciate. If the value goes up, that means that the value of the dollar, that means that the currency has appreciated. Back when I first started teaching economics, back about 10 years ago, the value one euro was equal to $1.35 US. Now 1 euro is equal to $1.13 US. That means that the value of the dollar compared to the euro over the past 10 years has appreciated. So you get more euros now for your dollar than you did 10 years ago. Okay, so exchange rates are constantly changing. The value that you would see today is not going to be the same as the value next year, nor will the value that you see today probably be exactly the same as it will be next Tuesday. They change daily. So in fact, they change more often than even daily. They change throughout the day. So let's see what causes exchange rates to change. There's several factors involved. First of all, the amount of imports and exports. If the United States runs a trade deficit with Japan, that will tend to have the effect of depreciating the value of the dollar. That is, as our trade deficit grows, the value of the dollar versus Japan will go down. Okay? If, on the other hand, we start importing less and the trade deficit shrinks or even goes into a trade surplus, the value of the US dollar would appreciate. It would go up against the value of the yen. So bigger deficit equals lower value of currency or depreciation. Less deficit or surplus equals a greater value or appreciation. Inflation. If you have high inflation, that will tend to make the currency depreciate. Okay, and so we would be looking at the inflation rate in the United States, say, versus the inflation rate in Japan. If the United States has a higher inflation rate, that will tend to make the US dollar depreciate against the value of the yen. If, on the other hand, Japan has a higher inflation rate, then the value of the US dollar vis-a-vis the yen should appreciate. The money supply. Here we're getting into simple supply and demand. If you have more money in a country, that's going to increase the supply of your money, and that's going to have a depreciating effect on your currency's value. On the other hand, if you restrict the growth of the money supply, that will have the effect of making your currency appreciate. So the bigger the money supply, that will make the value of your currency less. Interest rates. This one might be a little bit of a surprise. The higher the interest rate, the greater the value of your currency. The lower the interest rate, that will have a depreciating effect on your currency. And here's why. If interest rates go up in the United States, that means that overseas investors are going to start thinking that the interest that they can get on American investments is going to be a good deal. So overseas investors are going to start buying American financial securities to get the higher interest rate. That means that, they're going to have to exchange their currency for US dollars, because we're going to sell our financial securities in US dollars, not in some other foreign currency. So as more and more people overseas want to take advantage of America's higher interest rates, they will exchange their currency for dollars. They will demand more dollars, and that's going to force the value of the US dollar to go up compared to the countries overseas. So the higher the interest rate, the greater the value of the currency, or the currency will appreciate. Incomes. This one might also be a little bit of a surprise. The higher the income in a country, the lower the value of their currency. And you may remember I showed you back several days ago the graph of imports and exports, and it showed how when the economy is booming and people's incomes are growing, you have a bigger trade deficit. And then we saw that when the economy went into a serious recession, the trade deficit shrank. So what that means is when incomes were really growing with a healthy economy, people started buying more stuff from overseas. Imports increased, and that's going to cause your currency to depreciate. Then when we had a recession and incomes went down, a lot of people lost their jobs, you have fewer imports, and that will have the effect of making your currency appreciate. So the higher the income, the lower the value of your currency. Lower incomes have an effect of making your currency more valuable. And then finally, expectations. If I expect that the value of the dollar is going to decrease in the future, then I might choose to go ahead and exchange my dollars for other currencies now. Okay, so the expectation of a depreciation is actually going to cause the depreciation to happen sooner as big institutional investors start dumping their dollars in the expectation that dollars are going to go down in value, and they start buying euros or yen or some other currency instead. And as they do that, that will then force the value of the dollar down. On the other hand, if people expect that the value of the dollar is going to increase, overseas institutions may start dumping their own currency in favor of U.S. dollars and start getting, they're buying U.S. bonds, for example, starting to get American-based securities in dollars under the expectation that the value of the dollar is about to go up. And the very act of buying those U.S. securities denominated in dollars will in fact make the value of the dollar go up. So those are the main things that impact the exchange rate. I want you to remember these. So if you didn't get all these, be sure to replay this part of this presentation because you need to understand what makes exchange rates change. Okay, let's wrap it up by looking at how this is reflected in supply and demand. Okay, so first we're going to assume that the U.S. runs a trade deficit with Japan. How is that going to impact the value of the Japanese yen versus the dollar? And here's how that's going to look in supply and demand. What's happening here is the demand for yen is going to increase. Okay, so people in Japan, producers in Japan, want to be paid in yen. So people in America want Japanese products. They're going to have to get the US dollar converted into Japanese yen. So in other words, there's going to be an increase in the demand for yen. And as we all know, an increase in demand will make prices go up. So in this scenario, we go from price point 1 to price point 2. The value of the yen has gone up vis-a-vis the US dollar. Okay, let's move on. Here we're going to make the assumption, again, that the U.S. runs the trade deficit with Japan. Now we're going to show the impact of the trade deficit on the value of the dollar. The previous graph showed the impact on the value of the yen. Let's see how this works as we map out the impact on the value of the dollar. In this case, it's a supply issue. What happens is that there is a foreign currency market. Basically, it's housed in banks predominantly. And so when we are going to start buying a bunch more Japanese goods, what happens is we take our dollars and we have to sell those dollars on the international currency markets. And that's going to increase the supply of dollars in the currency markets. And as you know, an increase in supply is going to have a downward pressure on the value of a good or a service. In this case, we're increasing the supply of dollars in international currency markets. So the increase in supply forces the value of the dollar to go from price point 1 down to price point 2. And again, the reason the supply of dollars has increased in the international currency markets is that Americans who hold dollars are now buying more Japanese stuff. They dump their dollars in the foreign currency markets, and in exchange they're going to be getting yen, demanding the yen to get those Japanese products. Now, you personally don't do that. You personally don't go and exchange your dollars for yen when you buy a Japanese-made Toyota. But the person who imported the Toyotas into the United States did do that. And that's how this all works. The people involved in import and export of goods and services are the ones who are actually making the exchanges on the international currency markets. So we're going to stop here. Make sure you have all this in your notes. And just in case there's an assignment, I recommend that you go to Canvas and see if anything is there. And with that, we'll talk to you later.